Picking the right strike price in options trading options and picking the right strike price is all about finding that sweet spot between risk, reward, and probabilities. In today's video, I'll walk you through how I choose my strike prices, and how I turned a single trade into over $2,500 profit overnight by choosing the right one. Part 1. Understanding moneyness, ITM versus OTM. Before we dive into strike selection, let's talk about moneyness, specifically, what it means for an option to be in the money, ITM, or out of the money, OTM. For call options, being in the money means the stock price is above the strike price. The buyer can buy 100 shares at the strike price and sell them at the higher market value, locking in a profit. For put options, it's the opposite. You're in the money when the stock price is below the strike. You can sell shares at the higher strike price, even though they cost less on the open market. When an option is out of the money, there's no advantage to exercising it. A call is OTM if the strike price is above the current market price. You'd be overpaying for shares. A put is OTM if the strike is below the market price. You'd be selling for less than it's worth. If your option expires OTM, it becomes worthless. But if it's ITM, it has intrinsic value, equal to the difference between the strike and market price. Part 2. How I choose strike prices when buying options. When I'm buying options, my goal is to have them expire in the money. If they expire OTM, my investment goes to zero. To improve my chances, I look at delta. Delta tells you two things: how much the option moves with a $1 move in the stock, an approximate probability of the option expiring ITM. Example, a 0.70 delta equals approximately 70% chance of expiring ITM. A 0.30 delta equals approximately 30% chance of expiring ITM. Now, whether I go with a higher or lower delta depends on my confidence in the trade. Example, high confidence trade, SPY put debit spread. I opened a 407/406 put debit spread on SPY when it was trading at $422. The delta was only around 0.06, not great odds. But based on a pattern I noticed in SPY's chart, big drops in weeks 3 and 4 of each month, I expected a 7.5% drop, possibly below $400. Instead of aiming for 400, I played it safer and chose 407/406. I bought 30 spreads for $7 each, $210 total risk, but a potential $2,800 reward if SPY closed below 406. Example, low confidence trade, SPY leaps call. For long-term trades where I'm less confident, like buying a leaps call on SPY, I go deeper in the money with a higher delta. Let's say I want to buy a SPY call expiring a year out. Because I'm not sure the market will rally, I stick with an 80 to 90 delta. That could mean a 345 strike call with 81 delta, costing $9,400. Or a 295 strike with 91 delta, at $13,450. The more I spend, the higher the probability of the trade working. But if SPY drops below 295, that $13,000 plus could go to zero. Part 3. Choosing strike prices when selling options. Now let's flip it. What about selling options? When you're selling, your goal is the opposite. You want the option to expire worthless, out of the money. So you want a lower delta. A 30 delta equals 70% chance of expiring OTM. A 20 delta equals 80% chance of expiring OTM. Example, selling a put, low confidence in SPY rally. If I'm selling a put and don't feel confident about SPY going up, I'll go with a 20 to 30 delta. For example, a 408 put with 29.4 delta pays $196 in credit. Or a 405 put with 20.8 delta pays $125 in credit. Lower delta equals lower risk of assignment. Example, selling a call, high confidence in SPY drop. If I already own 100 shares and think SPY is coming down, I can sell a call at the money for maximum credit. SPY is at $414.12, so I sell the 414 call and collect $389. At the money, options pay the most because they have the most extrinsic value. In the money calls? Not worth it. The further ITM you go, the less time value, and the worse your break-even gets. Final thoughts. So to wrap this up, when I'm buying options, I adjust strike price and delta based on my confidence. When I'm selling, I aim for lower deltas to maximize my odds of keeping the premium. It's all about risk, reward, and probability. Thanks for watching all the way through. Massive shout out to my patrons for the support, you guys are the best. And as always, stay positive. Catch you in the next one.